Well, markets are still dithering a bit. One would have expected today that things would be up and away given the boost from the US markets, but it's been a little so-so. However, some of the stocks are standing out for the performance of their Q1 numbers, and among them is IDFC First Bank. That stock has done reasonably well. The numbers are pretty good. Actually, it's a many splendored result, you will have to say. Loan growth at 26% year-on-year and 7% quarter-on-quarter. Net interest margin only marginally lower. Net interest income rising by 36% year-on-year. So, it is a many splendored result. Joining us now is Mr. V. Vaidyanathan, Managing Director and CEO. Mr. Vaidyanathan, good morning and many congratulations. It's not like a journalist to start with so much praise, but it is deserved here. So let me start with the only one difficult part of your result, the pretty high cost to income. Any plans on how you are bringing it down? If you could do that, then, you can see your ROE perhaps going to 13, 14, really surging. Why is the cost to income high and what are your plans to bring it down?
First of all, thanks for the question, Latha. It helps us to clarify. See, basically one fundamental thing all investors should take note of the bank is it's at a setup stage. So whether we're building the mobile banking application, setting up the branches, setting up ATMs, putting out new products like gold loans or education loans, everything has setup costs. So while an established bank maybe built 20, 25 years ago, they built all that many years ago and today they're reaping the benefit of that. So this is the fundamental reason why cost income ratio of the bank is high. But let me tell you, directionally, it has already come down from 95 to 72. It will come down. We should, we should be patient with us.
Okay. No, of course, which also explains why your OPEX is high, growing 37%.
Well, OPEX has grown for all banks, I think, because a lot of expenses to incur, I think for the system as a whole, because of technology and all that. But I think specifically for us, it's still a setup stage. Remember, our deposits are growing by 45%. How is it growing? We've got to put something out there in terms of branches, network, etc. So, and we need that money because we have to repay high cost borrowing, which is costing us 9%.
That's the point. Okay, then that brings me logically to the next question on margins. Just an 8 basis point fall in margins is actually very creditable because we are already in a rising interest rate and rising interest cost scenario. Do you think you can hold it here or will it slip more for precisely the reasons you're saying?
See, we have one advantage, Latha, that our repo-linked loan book is only 24% of the book. So even if repo rates were to start coming down, let me say in due course, which I think it will, whether a year from now or whenever, our bank will not be much affected. Our entire repo plus MCLR book is only 39-40%. So we have some automatic cushions built into it. The second cushion that is built for our bank, which is rather unique for our bank, considering the situation, is that we have that 17,000 crores of money which we are paying. We're paying 5,000-6,000 crores every year. So that is giving us a lift. Otherwise margins should come down for the reasons we know. So they have a bit of a countervailing effect in each other.
Okay. What is your expectation in terms of asset quality? It's certainly improved, but we get this repeated sounds of alarm from unsecured credit. Some of the banks are already showing a bit of a disturbance, banks and NBFCs more. Do you think you'll be able to manage with even lower credit costs and even lower GNPA?
Yeah, as you know, in credit, the asset test is end of the day how much the credit cost, basically the provisions. Now that number is really very low for us, I think. And our gross NPA is only 1.53%. Our net NPA is only 4 or 0.45. So this is very low and credit cost also low. Now but the question is a fair question, and I use this opportunity to explain to all the viewers how a bank is managing such low NPA lending in our retail segments. There's only one and main reason for it. We lend to cash flow. It's very important, Latha. It's not against anything else. It's against cash flow. So imagine you saw a bank account and you saw money in the bank, say ₹1 lakh. Then we give an EMI of only 50,000 rupees. And naturally, EMI will clear. So we are very good in assessing cash flows. And that we believe is a bigger security. And frankly, we use that whether for secured loan, unsecured loan. This is the philosophy we follow. That's why for like 13, 14 years, our NPA is always so low.
Okay. Well, actually, you should tell us the secret of your deposit growth as well. It's a fairly strong deposit growth for a bank that does not have so much by way of margins. What would be what's working so well for you?
See, as you know, we dropped our interest rates by 300 basis points, not like a small amount, like 7% to 4%.
Exactly. And in spite of it, these kinds of margins.
Yeah. In fact, that helped the margins, of course. But then up to 10 lakhs, we are paying only 4% today, which is not very much premium over the big banks. But still, deposit going by 44. I think when we assess this situation, there are two reasons we think about it. We are really crazy about customer service. We tell our people day in and day out, service is everything for us, and so on. Things that really upset me, but only service will upset me if I find something going wrong in the bank.
Okay.
So that's one. Two is that one key inflection point in every bank's life. It happens when we pivot to becoming a brand, a good brand. That pivoting is happening for us. It's a very important thing. You think of a bank like ICICI Bank, HDFC Bank, they're phenomenal brands. But someday they pivoted to becoming a big brand. I think we are in that kind of inflection moment.
Okay. Yeah, I mean, I would agree with that. What I meant was not margins. The fact that, you have to work harder for deposits would mean you have to pay more than others.
No, we don't have to. We are settled. We have no intention to raise interest rates from here on. But still, we are confident of raise. We feel, I can't use the word confidence with any amount of, I should be careful with that. But let me say we are comfortable to guide that our quarter-on-quarter deposits will continue to grow from here on, at least for the foreseeable future, maybe 4 quarters, 6 quarters.
But with such a strong growth of... Sorry, go ahead.
It's very strong. Wherever we open a branch, for example, any city, for us, frankly, deposit for us for the taking. Because we just have, maybe 800 branches. If we put 100 more, wherever we go, like a gush of oxygen, deposits come to our bank. There's something very powerful about a brand, Latha. I think people have not, experienced it yet or discovered it yet.
Okay, that's very good to hear. Extremely good to hear. Would you, if with such a strong growth of both deposits and advances, you will have to raise capital sometime soon? I mean, it's very good now, but still the growth is very strong.
No, definitely. I think by end of this year, we plan to raise 3,000 crores. So our capital adequacy is touching 17% already. We still raise 3,000 crores by end of this year.
Would you ever look at inorganic opportunities? I mean, there are still a lot of southern banks which are, well, not quite proprietor-led, but by a few communities. Would you look at inorganic expansion, even NBFCs?
Well, we are a commercial entity and we should be on the lookout all the time. There are, if you notice, the key thing for the bank to address is actually cost-income ratio. And therefore, any organization that is very profitable in operating profit sense, we will be interested.
Okay. Can you give us a little more category on what you would be interested? Would it be MFIs?
It's not, we don't have a plan to look out anything like that. But certainly, let me say, any institution that is already up and running has a strong operating margin. That's important. Even PSL, we are planning to build a PSL book. Today, we are short on PSL, self-originated PSL. We, against a target of 40%, we originate only 32% on our own. By the way, this was like 15% or something a couple of years ago. It's caught up, but still, it's only 32. So we are short. So we are either buying or we're lending to MFIs and meeting the requirement. So we want such assets which can deliver PSL, can deliver profits. Other than that, frankly, if we do nothing also, we are pretty good. If you grow the way the bank is growing the next 3-4 years, you'll be surprised.
Okay. No, I just wanted to know if we should hear something in terms of inorganic growth this year itself, like FY24.
No, nothing like that. Nothing on the horizon.
Nothing on the anvil.
Through your channel, I'm putting out messages out there effectively that, we will.
Okay. All right. Let's get some numbers. I heard in your conference call you all are expecting about a 25% advances growth. What are you guiding in terms of margins?
We guide for like 22 to 24. That's a safe guidance for us on the loan book side. Today, our retail book is growing faster than that, and that's because the wholesale book is still, flattish. Come forward, when the wholesale degrowth stops and infrastructure degrowth stops, then retail itself will stabilize at 25-ish. It won't go gangbusters. So, and we believe that if it goes steadily at this rate, it should be good enough. On the margin front, Latha, like I said, there are countervailing factors. I said in the beginning to you. There are some factors which should actually lift our margin, some factors should bring down a margin, like FD rates repricing. Blend, 5 to 6 basis point reduction from here should be expected. But frankly, these things don't bother us, Latha, because you're looking from a quarter to quarter. I'm looking from a decade from now, but how to build the bank in the long run. These things don't matter. It's for us to more important to build it more stable and think long.
Okay. No, actually, 5 or 6 basis points from here on is not going to make a big difference at all. Even quarter. Yeah. Just a final question. Where are you seeing growth in terms of loan ask?
Small entrepreneurs is a big one. If it's a small and medium entrepreneurs, there is a very big demand coming up there. I think because of the government kind of investment happening in capex at 10 lakh crores and all that, even economies catching good steam. That is one big area for us. It's growing very well, and they are usually, it's a working capital financing. As a bank, think of an entire book as a working capital financing book. Because even if you give us a term loan, we are looking at the cash flow. When you have a working capital loan, looking at cash flow. So whether it's retail, wholesale, small entrepreneurs, large enterprises, we are in that space, and that is really growing well. No doubt about it.
Good to hear that, because that's what the stock market seems to be telling us today. It's the mid caps that are small caps and mid caps that are doing very well.
And we are seeing it live. We are seeing it live in a day-to-day life. We are finding strong demand coming from there. Strong demand, and rural India is totally underserved today. Totally, I can tell you. I don't know. India has been banking for 70 years, but the more I see rural India, more I'm surprised. There's no credit there. So just go there and.
So there's space for everyone.
Fantastically. Yeah. Our SMA, Latha, is only 0.85. Think about it. Not just forget NPA. SMA is 0.85. So these customers, rural India people, pay very well, actually.
Okay. That's very good to hear, sir. Pleasure speaking with you. Thank you very much for spending time for us, Mr. Vaidyanathan, and all the very best.
We have to wrap up on
Bazaar. We have to wrap up on Bazaar on that note. Chartbusters up next.